So today we will study about objectives of accounting. Before starting this topic, we'll learn in a general sense what is objectives of accounting. Accounting is basically a system for keeping track of all the money movements in a business. Think of it as scorecard for a company. And the main objectives are: 1. Systematic recording of transactions. Sys- the most basic goal is just to write down every financial event transaction that happens in the business in an organized way. This is called bookkeeping. You can't remember everything, so you need a reliable record. Real time examples: a coffee shop owner sells 10 lattes for $5 each. The accountant records a $50 sale. The owner buys a new coffee grinder for $500. The accountant records a $500 purchase of equipment. Without this, the owner would have no idea how much cash they should have or where their money went. And the second objective is ascertainment of result. The objective is about finding out if the business is making money or losing money over a specific period, like a year or a quarter. This is done by preparing the profit and loss P&L account, which compares all revenues, money earned, and all the expenses, money spent. Real time example: a software company's P&L account shows revenue $500,000 from selling software subscriptions, expense $400,000, salaries, rent, utilities. Result: a profit of $100,000. Why it matters? The management knows the business is working and can decide to expand or hire more people. If they made a loss, they would know they need to investigate the high expenses or low sales. 3. Ascertainment of financial position. This is about knowing what the business owes, assets, and what it owes, liabilities. At a specific moment in time, the snapshot is called a balance sheet. It shows the financial health of business. For example, a consulting firm's balance sheet shows assets: what they own, $50,000 in cash, $15,000 in computers, $30,000 owed them by clients. Liabilities: what they owe, $20,000 outstanding on bank loan, $5,000 owed to suppliers. Why it matters? A bank reviewing the balance sheet can quickly tell if the company has enough assets to cover its debt before giving them a new loan. For providing information for rational decision making. Accounting takes all the recorded data, summarizes and reports P&L, balance sheet, and gives them to all the people who need them to make smart choices. It's a language of business. For example, to a manager seeing high fuel expenses tells the delivery manager they should look into more fuel efficient vehicles. To an investor, seeing high and consistent profit growth might convince an investor to buy more stock in the company. To a tax authority, financial statements help the government decide how much tax company owes. 5. To know the solvency position. This objective focuses on whether the business can pay back its debts both in short term, like bills due next month called liquidity, and the long term, like a 10-year bank loan called solvency. For example, a business has $10,000 in cash and $8,000 in bills due next week. This is a good short-term liquidity position. The same business has a 1 million loan, but its total assets are worth 5 million and it makes a consistent profit. This indicates a good long-term solvency position, meaning it's unlikely to go bankrupt. Why it matters? Suppliers or lenders check the solvency to decide if it's safe to do business with computer company or credit. Let's come back to the PPT. Accounting isn't about recording numbers, it's about helping business understand, control, and improve their financial performance. to record financial transactions systematically. Every financial transaction, purchase, sale, expense, income must be recorded chronologically in the books of accounts. This ensures no transaction is missed and data is available for future reference. Example, if a company buys furniture for rupees 5,000, the transaction is recorded in a journal and then posted to ledger. The main reason because business keep accounts is to know whether they earned profit or suffered a loss. All revenues and expenses are compared in profit and loss account to find the net result of operations. Helps management and owners evaluate business performance. Example, if total sales 1 lakh and the total expense 80,000, then the net profit is 20,000. To ascertain financial position, knowing how much a business owns and owes at any point. The balance sheet shows the financial position by listing assets, liabilities, and capital. Example, assets 1 lakh 50,000 and liabilities 50,000, then capital 1 lakh. To provide information to stakeholders, accounting communicates financial information to those who need it. Stakeholders include owners, shareholders want to know profit and value. Managers use data to plan and control operations. Investors assess profitability before investing. Banks check ability to repay loans. Government uses data for taxes and regulation. Example, a bank may examine a company's balance sheet before granting a loan. 5. To help in decision making and planning. Accounting turns raw numbers into useful insight. By analyzing trends in income, expense, and profits, management can make better decisions. Helps in budgeting, cost control, and resources allocation. Example, if sales are declining, management may decide to increase marketing spend next year. 6. To comply with legal and statutory requirements. Accounting ensures transparency and compliance. Business must maintain proper books under laws like the Companies Act, Income Tax, and GST Act. Example, companies registered under the Companies Act must prepare annual financial statement as per Schedule 3 and end years.